Okay, imagine this. You've poured everything into your startup, right? Blood, sweat, tears. You watch it grow. It's finally taking off. Maybe there's an acquisition offer, a big funding round, maybe even an IPO. You're celebrating, thinking big, and then bam, the tax bill arrives. It can be a real cold splash of reality. But what if I told you there's some new legislation out there? Something specifically designed to, well, make that tax bill a lot less painful. Well, you're in the right place today. We're going to dive deep into exactly that, a new piece of legislation. Our sources are calling it the One Big Beautiful Bill Act, reportedly signed into law by President Trump on July 4th, 2025. Now, just to be clear here on the deep dive, our job is simply to look at what the bill says. Based on our research, we're not endorsing, any political names or the rhetoric around it. Our mission today is pretty straightforward. Give you, the listener, the ultimate shortcut to understanding these really big shifts in qualified small business stock benefits you might know as QSBS.
We'll break down the new rules, figure out who really benefits the most, and understand why it's causing such a stir in the startup world and among investors. And honestly, these changes, they seem to be the biggest boost to QSBS benefits in decades, like since it first started back in '93. So yeah, this should be a pretty important deep dive for anyone building or funding new companies. Okay, so let's unpack this a bit. Before we get into the nitty-gritty of what this new bill actually changed, maybe just a quick refresher. What exactly is QSBS for anyone who maybe isn't deep in the weeds on this? And maybe more importantly, why are these specific changes such a big deal right now?
Absolutely. Happy to. So QSBS, Qualified Small Business Stock, it's basically a section 1202 of the Internal Revenue Code. That's the big book of U.S. tax laws. It was originally created to, well, encourage people to invest in small, growing businesses. The carrot, if you will, was offering potentially huge tax breaks on capital gains when you eventually sell that stock.
Okay, so an incentive.
Exactly. A pretty powerful one, actually. For founders, for investors, it reduces the potential tax hit if the venture succeeds, makes taking that risk a bit more palatable. Now, why this new legislation is such a big deal? Well, you hit it. It brings in some really significant expansions to those existing QSBS benefits. We're not talking about little tweaks here. These are the most substantial changes, really, since the whole thing was enacted back in 1993. That tells you right away how impactful this is potentially going to be for the startup ecosystem.
Wow, okay. Since '93.
Mm-hmm.
That was a long time.
Yeah.
You can see why people are talking. It must change the whole risk calculation, right? For investors, for founders.
Yeah.
So let's get into the mechanics. What did the legislation actually change? You mentioned the holding period earlier that sounded like it could be a real game changer for flexibility.
It really is. Historically, the rule was pretty rigid. You had to hold the stock for more than 5 years to get any QSDS benefit at all.
5 years. That's a
Yeah.
long time in startup land.
Exactly. All or nothing, which often felt, well, impractical given how fast things move. This new legislation completely changes that dynamic. It introduces a brand new tiered exclusion system. But key point, this is for stock acquired after July 4th, 2025.
Ah, okay. So only for new stock.
Correct. For that new stock, you can get benefits much sooner. Hold it for at least 3 years, you get a 50% exclusion on your gains. Hold it for at least 4 years, that bumps up to 75% exclusion. And if you hold for 5 years or more, you still get that full 100% exclusion up to the limit. It's a dramatic shift. Way more flexibility, earlier access to tax breaks. Think about it. Sell it 4 years under the old rules. 0 QSBS benefit, full tax. Sell it 4 years now under these new rules. You exclude 75% of the gain. That's a massive difference. Turns a potentially huge tax bill into something much, much smaller.
Okay, so holding period, dramatically better. Got it. But is it just about getting the benefits sooner, or did the actual amount you can exclude change too? Is the payout bigger?
It's both, actually.
Yeah.
Good question. The previous maximum gain you could exclude per taxpayer, per company, was capped at $10 million.
Right.
The new legislation gives that a serious boost. For QSBS acquired after that July 4th date, the new cap is $15 million.
15, so 50% higher.
Precisely. You can potentially shelter 50% more in capital gains from federal taxes. And another important detail, this new $15 million limit, it's going to be indexed for inflation starting in 2027.
Oh, that's smart. So it keeps its value over time.
Exactly. It adapts. Now, the alternative cap, the one based on 10 times your initial investment, your basis, that part stays the same, which is still really valuable, especially if you put in a very large amount initially. If your basis was, say, over $1.5 million, that 10x rule might let you exclude even more than the $15 million. So it gives another option for those specific high basis situations.
Right. That $15 million cap plus inflation indexing. That definitely sweetens the deal.
Yeah.
Okay, so we've got holding periods, we've got exclusion caps. What about the companies themselves? Does this change which companies can even issue QSBS? Can, like, slightly larger startups qualify now?
That's another key change, and yet it broadens the pool. Previously, for a company's stock to qualify as QSBS, the company generally couldn't have gross assets over $50 million right after the stock was issued.
50 million, okay.
The new legislation raises that ceiling quite a bit. For stock issued after July 4th, 2025, that threshold is now $75 million.
75. Okay, another significant jump.
It is, and just like the exclusion cap, this $75 million threshold will also be adjusted for inflation starting in 2027. What this really means is that while more mature startups, companies further along in their growth stage, can now qualify for QSBS benefits longer into their development.
Ah, interesting.
Yeah, it expands the window. It means companies whose stock can offer these tax advantages aren't just limited to the very, very early stage, pre-Avenue type ventures anymore.
Okay, these are definitely big numbers, big changes. Let's try to bring it down to earth a bit. What does this actually mean for the people involved? The founders grinding it out, the investors writing the checks. Let's start with founders. How does this hit their bottom line, their decisions?
For founders, honestly, these changes could be transformative. They impact everything from exit strategy to personal wealth planning. First off, just enhanced exit flexibility.
Right, that tiered holding period.
Yeah, exactly. Being able to get meaningful tax benefits after just 3 years instead of waiting for 5, that gives founders so much more agility around when they might sell or take the company public. It's huge in a market that moves so fast.
Yeah.
I mean, you hear stories, right? Founders feeling forced to wait out that 5-year clock, maybe missing a good acquisition window. This new tiered system should really help alleviate some of that pressure.
Makes sense.
Then, building on that, there's simply increased tax savings. That higher $15 million cap means founders can shelter 50% more gain. Let's put some numbers on it. Say a founder has a $5 million gain after 4 years.
Okay.
Under the old rules, they might have paid full freight. Under the new rules, with the 75% exclusion at 4 years, they'd save potentially over $1 million in federal taxes compared to before, just on that $5 million gain.
Wow, $1 million. That's substantial.
It really is. Then there's that extended eligibility window we just talked about, the $75 million asset test. This is great for founders whose companies are scaling fast or maybe issuing equity later in their growth. Their company stays QSBS eligible for longer. And finally, the tiered system itself offers strategic planning opportunities. Founders can now make much more informed decisions, about when to issue equity, how to structure things, and critically, how to think about exit timing, knowing they might capture partial benefits, even if they don't hit 5 years. It allows for more nuance.
Yeah, that flexibility for founders seems massive. Takes some pressure off that critical exit timing decision. What about the other side of the table, the investors? Angels, VCs, the folks funding this innovation. What's in it for them?
Oh, huge advantages for investors, too. It really makes startup investing even more attractive across the board. First, just improved investment attractiveness. Simple as that. Better QSBS benefits mean a lower effective tax rate on successful exits. Plus, getting access to those benefits sooner, that fundamentally shifts the risk-reward calculation for investors. Well, think about it. If the potential tax bite on your winnings is smaller, especially in those higher-risk, early-stage deals, it makes those investments look much better compared to, say, safer, lower-return assets. It could potentially unlock more capital for startups.
Interesting point. More capital flowing in.
Potentially, yes. It also allows for better portfolio optimization. Investors can align their exit decisions more closely with what makes sense for the business, rather than being rigidly tied to a 5-year tax clock while still capturing significant tax advantages. For venture capital firms, especially those structured as pass-through entities where profits go directly to their limited partners, the LPs.
Right, avoiding double taxation.
Exactly. These enhanced QSBS exclusions directly benefit those individual LPs when a portfolio company exits successfully. It's a direct boost to their net returns. And for angel investors, they often recycle capital, right? Invest, exit, reinvest in the next startup. These changes give them incredible flexibility to do that faster without waiting years just for tax reasons, all while getting substantial tax breaks. It helps keep that early stage money moving.
Okay, that makes a lot of sense. The tax savings example you gave for the founder, the potential $1 million saving, was really powerful. Can you give us a similar, really clear example for an investor, just to hammer home the practical impact here?
Absolutely. Numbers really make it clear, don't they? Okay, imagine an investor puts $100,000 into a startup. It's QSBS. The company does well, and 4 years later, that stock is worth $5 million.
Nice return. So a $4.9 million gain.
Right. Now, under the previous rules, because they only held it for 4 years, less than the 5-year minimum, they get zero QSBS benefit. They'd face the full federal capital gains tax rate, let's say 28% for this type of gain.
Right.
That works out to roughly $1.37 million in federal taxes on that $4.9 million gain. A big chunk.
Yeah, definitely.
Okay, now let's run the same scenario under the new rules. The One Big Beautiful Bill Act. They still held for 4 years, but now that qualifies for the 75% exclusion tier. So they only pay federal taxes on 25% of their $4.9 million gain. Their tax bill drops dramatically, down to approximately $343,000.
Wow. From $1.37 million down to $343,000.
Wow. From $1.37 million down to $343,000. Exactly. That's over $1 million in federal tax savings.
Yeah.
Purely because of this new tiered structure and the expanded benefits. For that investor, that's a huge difference. Capital freed up to reinvest or, whatever else.
Over $1 million.
Right.
Just on that one investment example. That is staggering. It really puts into perspective how much capital this could keep in the hands of investors and founders. Okay, so the benefits are clear, potentially massive, but timing seems crucial here. Are there any important catches or caveats, things that you, our listener, really need to keep in mind? What about stock people already own?
That is the critical point for anyone holding existing stock. And yes, there's a very clear line. These enhanced benefits, the tiered holding, the $15 M cap, the $75 asset test, they apply only to QSBS that is acquired after July 4th, 2025.
Okay, strictly forward-looking, no retroactive gifts.
Precisely. It's not retroactive. If you hold stock issued on or before that date, July 4th, 2025, it's still subject to the old rules.
Wow.
The 5-year cliff, the $10 million cap, the $50 million asset test. So there are no retroactive benefits. You can't, for example, just exchange your old shares for new ones after the date and suddenly qualify for the shorter holding periods on that existing gain. It has to be genuinely newly acquired stock after that date.
Got it. Clear dividing line.
Very clear. But this does create interesting strategic issuance possibilities, right?
Yeah.
Companies that might be close to that $75 million asset threshold or founders thinking about future equity grants might now strategically time issuances after July 4th, 2025, specifically so that new stock qualifies for these better benefits, assuming they still meet the other QSBS criteria, of course.
Right, so careful planning around that date is key.
Absolutely vital for both companies and investors going forward.
Okay, that makes sense. So if we zoom out again, connect us to the bigger picture. What's the government hoping happens here? What's the intended broader economic ripple effect from these tax changes?
Well, the underlying goal seems pretty clear. Stimulate investment in domestic startups. The Joint Committee on Taxation, which analyzes these things, estimated these changes could mean about $17.2 billion less tax collected over the next decade.
So $17.2 billion staying in the private sector, potentially for reinvestment.
That seems to be the idea. It signals a commitment, really, from the federal government to encourage investment specifically in American innovation in U.S.-based startups. By making the potential rewards greater through lower taxes on success, it lowers the perceived risk for investors and for founders. The hope is this spurs more entrepreneurship, more early-stage funding.
And maybe directs that funding towards certain areas.
Potentially. It's particularly relevant now, with the focus on tech sectors like AI, biotech, other emerging technologies that are driving a lot of new startup creation. This could provide extra fuel for those areas. Ultimately, the enhanced QSBS rules create stronger incentives for founding teams, for early employees who often get stock options, for the investors who back them, stronger incentives to take those entrepreneurial risks, knowing the potential upside is significantly better protected from taxes. So yeah, these changes to QSBS, they really look like a significant win for the whole startup ecosystem. More flexibility, higher potential savings, longer eligibility. It all aligns much better, I think, with how startups actually grow today.
That alignment point is interesting. It feels less like a tax rule working against the grain of startup cycles and more with it. So what does this all mean for you, listening right now? Well, it means a pretty significant shift, potentially, in how we reward entrepreneurial risk-taking in the U.S. and how investment might flow into those new ventures. The landscape just got arguably a lot more interesting for anyone looking to build or fund the next big thing here.
And that leaves us with a key question for you to think about. How might these expanded QSBS benefits really reshape the landscape? Think about startup creation itself, funding strategies, even how companies plan their exit timelines over the next few years. Could this genuinely ignite a new wave of American innovation? Something to ponder.
Definitely something to ponder. Thanks for diving deep with us today into these really crucial changes shaping the future of startups and investment.